Hi everyone, thank you for joining today's webinar, an overview of the Quantopian risk model. Our speaker today is Max Margenot. He is our academia and data science lead at Quantopian. Max's background is in applied mathematics, statistics, and quantitative finance. He runs the online lecture series at Quantopian and is responsible for workshop curriculums and educational content. In addition to having experimented with algorithmic trading of cryptocurrencies and Bayesian estimation of covariance matrices, Max has published work in theoretical mathematics. He works with top universities including Columbia, the University of Chicago, and Cornell, and he holds a Master's of Science in Mathematical Finance from Boston University. As always, today's webinar is being recorded, and we will do a short Q&A session at the end of Max's presentation, so be sure to enter your questions into the chat box, and he will get to them at the end. Thanks, Max.
Thank you, Paige, for the introduction, and welcome everybody to yet another webinar from Quantopian. Today we'll be talking about the most romantic aspect of algorithmic trading of all, this fine Valentine's Day, risk modeling and risk-constrained portfolio optimization. So just to provide a little bit of context, whenever we're talking about the returns of an algorithm, the returns of any sort of portfolio, it's not enough to just consider that pure value that you get out of it, right? What we really want is new value, something novel, something interesting. And to do this, we really need to have a firm idea of risk and how it affects our portfolio, right? There are these common factor risks that will negatively impact any return stream, just because it exposes us to a lot of things that we might not necessarily want to be exposed to, right? So I'm going to dig into this a little bit more in the risk-constrained portfolio optimization lecture. So if you navigate to the lectures page, that is over under Learn Lectures, or you can just navigate to quantopian.com/lectures. And it's this lecture 34, risk-constrained portfolio optimization, which I'm going to clone now, and we can get right into it. So whenever we discuss risk and discuss alpha, we need to really understand what we're talking about, right? Alpha can only really be understood in the context of risk, or understanding what sort of risks are involved. We here at Quantopian define alpha, and in general, alpha is defined as whatever your returns are, less the risk premia associated with those returns. Every single source of quality return is going to be associated with some risk premium or another. It's just part of modern portfolio theory that higher risk nets some sort of higher reward. But what we care about is that these risks aren't systematic. We want these risks to be risks that we specifically want to take on, rather than risks that are going to affect large swaths of the market, right? In reducing these common factor risks, in getting rid of these risks that affect large swaths of the market, we try to improve the quality and consistency of our returns. Any sorts of unexpected risks that can come in from these common factor stuff cannot be relied upon to produce continuous profits. And when we're dealing with a trading strategy or dealing with any sort of portfolio that we've assembled, what we want is to consistently produce profits. So by eliminating unexpected risks, we should ideally only get exposure to risks that we want to be exposed to. And the primary way that we evaluate risk is using factor modeling. It's something that we harp on a lot in the lecture series. And factor modeling, when it really gets down to it, is just a rebranding of a linear regression or a multiple linear regression. A classic risk factor model is usually expressed in this form, where we take the returns of some company or some stock or some trading strategy and regress them in terms of some intercept and a set of risk factors and some error. So what we're saying here is we're literally expressing that the returns of our portfolio, the returns of our strategy, are equal to the returns contributed by some set of risks. And this can be stuff as simple as the market or the Quantopian risk model, which incorporates like 16 different factors, right? And since this is just a multiple linear regression, we can add as many additional factors as we want in order to account for different things. If we're worried about the influence of one sector above all others, well, maybe we just want to include that one sector rather than the market at large or other sectors. It really comes down to it. We have some number of factors k, and this alpha is what we're trying to get to. We always define alpha in terms of our returns less the returns that we get from these common factor risks. So our definition of alpha is going to vary based on how many individual factors that we use, right? If we use only one factor, then, well, one common risk factor, then the alpha that comes from that model is going to be different from if we use 3 or 4 or 5 different factors, right? Just because we're adding additional terms to this multiple linear regression, the estimations are going to be different, and you're going to get different values for the intercept itself. So in order to quantify these unexpected risks and to have acceptable risk levels in a given portfolio, we need to answer 3 questions. What proportion of the variance of my portfolio comes from common risk? And I guess the converse would be what proportion of my variance comes from specific risk that we actually want to deal with? How do I limit this risk? And where does the return or P&L of my portfolio overall come from? How much of my return is coming from these common factor risks that could disappear at any time, and how much is coming from some consistent alpha that I've researched and tried to really harness in the way that I express my strategy. I mentioned the market once or twice. The market is the classic risk factor. If you have the capital asset pricing model, all that we're doing here is we're expressing the return of our portfolio, the return of an individual stock, in terms of an intercept and the returns of the market, one factor alone. And what this beta value gives us is literally the proportion of our returns in the portfolio that comes from the market itself. And this is the classically defined market beta. I'm probably going to say beta a few more times, and I mean beta in general, not the specific market beta. Just the beta of any individual factor can be determined like that, unless I say specifically market beta. That's when I mean SPY or the S&P 500. So we can extend this capital asset pricing model to include 2 additional factors, price to book ratio and small minus big. Well, high minus low and small minus big, that's high price to book ratio minus low book to price ratio, and small market cap minus big market cap. And these try to capture different aspects, right? What makes something a risk is whether enough people know about it, whether enough people are trying to incorporate it into something, right? Everyone is impacted in some way by the market. So the influence of the market is going to be paramount in any individual strategy. But, well, if we're looking at small minus big, then this is trying to harvest some risk premium of small market cap stocks over higher market cap stocks. Small market cap stocks tend to have a lot more volatility. They tend to be in some way tied to the market. This results in a difference between small market cap and big market cap stocks. So that's a worthwhile thing to include. The book to price ratio tends to incorporate an idea of growth stocks that people really try to get at. So by adding these 2 things to our multiple linear regression here, or any multiple linear regression where we're trying to express risk, we can ideally reduce our common factor risks by adding more of a face to them. We can also add individual sectors or individual industries. That we can do just by looking at individual ETFs that try to track the tech industry or the consumer defensive industry or any of these individual things. And we can add these to this risk model. We can take in macroeconomic factors like inflation or interest rates and try to incorporate that, try to see how that affects our portfolios, because those are going to be large global effects, right? And then we can also try to incorporate these statistical factors that are based on historical returns and derived from principal component analysis, PCA. We actually recently added a lecture on principal component analysis that specifically talks about how to construct a statistical risk factor on a portfolio of stocks. So check that out. That's also on the lectures page. So what I want to do is build up a super basic risk model before we can dig into a little more of how we incorporate this into an optimization problem, right? So the first part of any trading strategy, any portfolio that we want to form is defining the universe. So for the base universe, we're going to use the Q-Tradable Stocks US, which is just this algorithmic filter that we've created that allows you to trade only the most liquid stocks in the U.S. equity markets. And the reason we're concerned about liquidity is just whenever you're trading with a trading algorithm, you kind of set up a list of instructions and let it run wild. And it's depending on being able to actually execute those instructions, actually turn some sort of signal into trades. And if it can't turn that signal into trades due to illiquidity or any other issues in the market, then your algorithm is going to have trouble fulfilling its mandate, and it might go a little bit off the rails. So by keeping a liquid market, you make it easier for the algorithm to execute its trades. You make it easier to actually get that return stream going so you can actually evaluate. So this is why it's important to have a liquid universe. So first, we import these libraries here, NumPy pandas, stats models, and a bunch of pipeline stuff here. What we're going to do is run a pipeline on some fundamentals information for the market cap and the book to price ratio in order to construct these Fama French portfolios. So our date range is from 2009 to 2011 on the 1st of January, and these are the returns of this universe overall. And we just make this super easy to include. So we have an idea of what the market looks like. And these are the assets that go into this whole thing. So in making our pipeline, what we want to look at is, okay, we want the biggest market cap stocks, so we'll take the top 500 there, and we'll take the smallest market cap stocks. We'll take the highest price to book ratio here, and the lowest book to price ratio here, again, 500 in each. We add these to our pipeline, and then we run that pipeline here. We construct a return stream for the long side of the book and the short side of the book. So here what we're doing is we're creating a long-short equity portfolio. We've got a couple lectures on that as well. But what we want to do is take the stuff that has the highest market cap and subtract the returns of those from the stuff that has the smallest market cap. And in that way, we get small minus big, the returns of these small market cap stocks minus the returns of these large market cap stocks. Then what we're going to do is we're going to take a high price to book ratio, same setup as the small minus big portfolio, and the low book price to book ratio, and we'll take the difference there to make high minus low. We add these to a data frame here that we can combine with the returns of the market itself, SPY, and concatenate all of these together into our factor portfolio. So if we look at this graph here, this is the cumulative returns of our fundamental factors, the market, small minus big, and high minus low. And what we want to know is how these returns impact the returns of our portfolio. So what we do is we express this in a linear regression, just as above. We say the returns of each individual stock in the universe is equal to some intercept term plus beta times the market plus beta times high minus low plus beta times small minus big plus a little bit of noise. In this way, we can quantify the influence of the market, high minus low, and small minus big all together. And this lets us get a more granular view of the sorts of risks that our portfolio is exposed to, right? If we have a very low market exposure, but we have very high minus low or small minus big exposure, this is more informative than we just have a super low market exposure, right? We have a better idea of the common factor risk associated with our portfolio. So what we want to do is compute this for every single asset in our portfolio, right? We take every single potential asset in our universe. We take every single stock in the Q Tradable Stocks US, and we express its returns as a function of its own alpha, beta times our market, beta times high minus low, and beta times small minus big. And what this gives us is for each individual stock, 3 different risk exposures. And now doing it for per individual stock may be computationally intractable for a lot of people, so it's also totally okay to just take the returns of the portfolio itself and express those in terms of the returns of these 3 common risk factors, or whatever common risk factors you want to deal with. It's just a different approach, also totally valid. So what we do here is we compute this least squares regression here, we fit it, and we pull out the beta exposures and calculate the residual of this, getting out the alpha value. And then if we plot all these out, we see that we can get an individual risk exposure for each common factor risk for every single security in the universe. So ADSK is a pretty high market beta, it's around 1.4, but a small minus big beta that isn't that bad, still positive, and a high minus low beta that is negative, right? And this lets us get a granular view of how each individual asset in the universe that we're trying to trade is affected by things. So Apple has a pretty high market beta, a pretty inconsequential small minus big beta, and a little bit of a negative high minus low beta. So first, what we want to do here is we want to take the assets in our universe, we want to take these fundamental factors and the exposures to these fundamental factors, and what we want to do is use these to split our variance into common factor and specific risk, right? Here's what our fundamental factors look like. We have these return streams for the market, small minus big and high minus low, and for every single individual asset, we have a beta for each of those individual risk return streams. Now, in order to split our variance into these common factor risks, well, we want to re-express portfolio variance, sigma squared, in terms of the common factor risks and these idiosyncratic risks, the specific variance here. So in order to get this common factor risk, well, we need the matrix of factor exposures. We need the covariance matrix of those factors. We need the weights that we're allocating to each of those n assets. Then these specific returns, we only need the specific variance. So our variance that has all of the common factor variance removed, and the weights for each of those individual assets. So in order to do this, well, we'll say that we have an equal weighted portfolio of our entire Q tradable stocks US universe here. We're going to say that we're just going to put an equal proportion of our portfolio in each of these stocks. Now, this isn't market cap weighted, this isn't dollar weighted or anything. This is just, I want some percentage of my portfolio, 1/1500th or however many stocks there are in the Q tradable stocks US, and I want to put that into each individual stock. And to compute this common factor variance, we're just going to express this formula here, and we get that there's some pretty small variance associated with this portfolio, or associated with the entire with the entire tradable universe that we're going to be dealing with. But this is significantly higher than the specific variance associated with it, right? Our specific variance is basically 0, while we have, well, a 10,000th at the very least in the common factor variance. So in order to really get a good idea of what this means, right? These are pretty small numbers. What we want to do is take the total sum of this variance, right? Because the total portfolio variance is equal to the common factor variance plus the specific variance. And we want to take the ratio of the common factor variance to each of those. And we see that common factor risk makes up 99.83% of this portfolio. And this is just, we're going long and equal in equal value each single security in our universe. So if we're just buying stuff long, if we're not trying to do anything clever, we're getting almost only common factor risk with almost no specific variance. Now, what we want to do is take this sort of thing into account when we're allocating to these different assets, right? This equal weighted portfolio is a very naive approach at first glance. Instead, a good way to look at this is to add these risk exposures and to add these things that we don't want as another constraint in our portfolio optimization routine, right? That might give us a better way to deal with this than just equal weighting everything. So we can define some objective function. That could be anything that we're already used to, right? It could be something like a Markowitz objective function, where we're just trying to minimize the variance. We can try to maximize the Sharpe ratio. However we want to define this objective function, that's up to you, right? We can do whatever we want there. The important thing in incorporating these risk factor exposures is to add this additional constraint here, that we have some maximum risk budget for each individual asset, right? We have some space of potential factor exposures, but we want to make sure that it's only acceptable. It's only what we find acceptable. So if we set this value of f here to 111 or to a maximum of 111, what we're saying is that we want a maximum factor exposure of our portfolio to each individual factor to be less than 1. We have this massive space of potential weights that we can allocate to individual assets, but we want to reject all cases where those weights result in a portfolio that has a factor exposure to each individual factor of greater than 1, right? We can reduce these even more to 0.2, 0.2, 0.2, 0.4, 0.4, 0.4, whatever we want, in order to restrict our exposure and basically allot our risk budget, the amount of risk that we actually want to take on from common factor stuff, and add that to the optimization routine. Yeah, so if we generate some random weights here and look at how the weighted factor exposures change, we'll just take a random number equivalent to the number of assets in the universe, and then we'll scale those down so they all add up to 1. Then if we take the factor exposures of this new portfolio, we see that, well, we have a pretty small high minus low beta, a decent small minus big beta, and a market beta of around 1. So the way that we actually get the factor exposure of this total portfolio is just by multiplying the factor exposure of each individual asset by its appropriate weight. Just as when we calculate the returns of an overall portfolio, we express it as a weighted sum. The risk of this portfolio, the risk exposure of this portfolio total for each individual common factor risk is again going to be a weighted sum, weighted by the allocation to each individual asset. So this is the general form of a risk-constrained portfolio optimization. Expressed in this abstract way, it might be a little much, but conveniently, we have some stuff already built into the platform that you can use when dealing with an algorithm. We have a risk loading pipeline that will give you the risk exposure for every single individual asset in your desired universe, and you can pass that in as a constraint to our optimizer in order to do exactly this, in order to reduce the risk of your overall portfolio or the risk exposures to each common factor risk. Now, that risk loading pipeline is going to give you all of our individual risk factors. That's going to be the 11 sectors and the 5 style risks, right? Because there are a few different things you want to deal with. When we're looking at an individual stock, it might make more sense to look at the industry within which it resides than the market at large, just because the industry that it resides within is going to give you a more granular idea of the common factor risk associated with fluctuations in the industry, fluctuations in given markets of that stock. And then this style risk, what I'm trying to get at with this, and what we're in general trying to get at with this is common strategies in the overall market. Having a look at how, just some additional risk factors to look at how novel one idea or another is. If you want a pre-baked example that already has this risk loading pipeline code passed into the Optimize into the Optimize API and everything else already baked in, then you can just go to the lectures page again. We have a long-short equity template, which is a factor modeling template. You can plug in and play with your own risk factor, with your own alpha factors that you've developed, and you don't have to deal with making the risk loading pipeline and doing everything else because the code's already right in there. So go clone that algorithm and start tinkering. So I want to look at a decomposition or a performance attribution of our risk model, or of an algorithm using our risk model. So I'm going to take this back test from a Wall Street Journal post on our forums. And what this algorithm is it's just a long-short equity algorithm that does a very, very basic mean reversion factor. It just takes the most recent price and divides it by this rolling mean of the last n prices. And it uses that to rank stocks. So anything that is particularly highly ranked, that has a particularly high return relative to the mean, we're going to go short on that. And anything that has a particularly low return relative to its mean, we're going to go long on that. And ideally, we'll be able to harvest this reversion to the mean using this. So we load the backtest like this, and we create a performance attribution tear sheet. And what this gives us is the annualized specific return, the annualized common return, and the annualized total return, as well as the specific Sharpe ratio. So the Sharpe ratio that we're getting just from new interesting stuff, our alpha. And it gives us this summary of our exposures. So to basic materials, we have a pretty low risk exposure, pretty low consumer cyclical, financial services, real estate, consumer defensive. All these other sectors are relatively low. But when we get into this, these style factors, momentum, size, value, short-term reversal, and volatility, we start to see some differences, right? The way the algorithm operates is it picks a very large swath of stocks, about 500 long, 500 short, which tends to remove market influence. And because we're picking so many different stocks from so many different industries, and we're going long and short in all of these industries, it tends to keep all of our sector exposures pretty down. But this is a mean reverting algo, right? And mean reversion is the opposite of momentum. So we have this negative exposure to momentum here, as well as this positive exposure to short-term reversal, which is just short-term price reversals. Then a pretty small exposure to volatility, okay exposures to size and value. But this short-term reversal and this momentum exposure really showcase the limitations of dealing with this mean reverting factor. It's just this very unsophisticated mean reverting factor. We have a decent amount of risk associated with it. I think it's still within the risk constraints for the contest, but it's about what we'd expect. It's more than we would want, and it's about what we would expect. So here's the cumulative return series of everything. Here's the returns associated with the Bear algorithm, the cumulative common returns, and the cumulative specific returns. And we see that we have some pretty high cumulative common returns when we really break it down. Here's the individual daily returns for each individual risk factor, as well as the daily risk factor exposures. And we can see, okay, these are relatively small, and these spikes in short-term reversal, I believe, are when we actually rebalance this portfolio. So we rebalance monthly, and it seems like every single time we reposition ourselves, we take on a large amount of short-term reversal exposure, and we get this negative exposure and momentum, again, at these same exact dates. So this would basically disqualify this algorithm from being entered in the contest, because our daily risk factor exposures are pretty high. They're fluctuating pretty highly. So even though these means are small, that just depends on the day, right? When we're most going to be impacted by this is when we're rebalancing everything and trying to actually make new positions and close old positions. And that's when we're going to really be hurt by these common factor exposures. Now, it's difficult to remove common factor risk entirely. What it really comes down to is iterating upon your factors, trying to specifically design them so that you're not being influenced by any individual sector too much, trying to be mindful if you're doing like a pure mean reversion strategy, that you may end up with a short-term reversal, or you may end up with a negative exposure to momentum. These are just some things that come along with particular styles of strategy. We're working on some tools in AlphaLens in order to allow you to more rapidly iterate upon a factor that you've developed in order to see whether it has a common factor risk exposure before you bring it into a backtest, right? If you're iterating on a signal in the research process before you bring it into a backtest, it allows you to move faster and more quickly find a novel idea that you can then bring to a backtest. Because ultimately what we want to do is make the backtest just the last thing, right? The research process is really where you can find quality alpha. You take this unstructured data, you compute some reduction upon it for each individual asset, and you use that to construct a cross-sectional or an event-based portfolio or some sort of portfolio or another. And then what you want to do is be able to test whether that signal is even viable, see whether it's predictive in the first place. And if it's not predictive, well, then you can just start again, get a new research factor, and so on and so forth, designing it with all these common factor risks in mind. Then once you have a factor that you're confident in, that's when you bring it to a backtest. That's when you run it and simulate real market conditions to see how it impacts. And this is when we're going to do like a performance attribution using this tear sheet here, the performance attribution tear sheet. So that's about the grand total of this lecture individually. So I think we can take some questions now.
Okay. So like I said, if you have a question, please insert it into the text box, and Max will start answering them, but we can add them as we go.
Okay, so as of right now, we only have one question. This is, what is the intercept in a real-life example? So in a real-life example, this intercept is what's left over. It's the excess, right? And that's kind of the way it works with any linear regression, right? But what this intercept is in terms of the risk model is literally the alpha, the specific return associated with our return stream, the specific return associated with our trading strategy. Since we're saying that the return of an individual stock or the return of an individual portfolio is equal to some combination of risk factors and something else, that something else is what we want to deal with, right? Because we want to reduce as much as possible the influence of these risk factor returns in order to maximize this intercept and in order to maximize what is unexplained by the individual risk factors. And in real life examples, this is going to vary depending on how many individual factors we use, right? We have these common factor risks here, and each of these individually is going to provide some extra impact. And if we only use some subset of this, then it's going to change. So the literal actual expression of this intercept with this algorithm example is this specific returns curve here, the accumulated alpha, right? And these common factor returns, cumulative common factor returns, this is the risk factor returns. So in this particular case, we have a smaller amount of specific returns, a smaller amount of actual alpha compared to the common factor returns. So are there alternative rebalancing approaches, maybe using machine learning models and not linear ones? There are definitely a bunch of different ways that you could optimize a portfolio. This is just a way to define portfolio optimization in a convex way. A lot of machine learning problems end up being a non-convex optimization. And currently, our optimizer is for convex optimization, as far as I understand it. So these constraints need to be in some way expressed like this to make it easier. But yeah, you can definitely use a machine learning model to rebalance. Currently, we don't have that functionality on Quantopian, but it's definitely an option if you want to deal with it, using some sort of genetic algorithm or something else. The risk there is that if you're using a machine learning algorithm, is that you might end up overfitting. It's pretty easy to overfit whenever you're not appropriately handing out sample testing, dealing with other stuff. So that's definitely something to be mindful of. Could you please explain again why risk exposure, momentum, and reversal are high on the day of rebalancing? So those are the days when we actually, each month what we do is we reevaluate our factor, our mean reverting factor, to change the assets that we want to invest in, right? Some are going to fall out of this long side of the book. Some are going to fall out of the short side of the book. So the day of rebalancing, we have the highest possible mean reversion exposure that we could have, which means we also have the highest possible negative momentum exposure that we could have, right? Because that is the day upon which we have decided, okay, we're going to buy all of the assets that are going to revert to the mean. And this is what gives us these spikes in exposures here. How powerful would you say that reversion is? Can you derive buy-sell signals using it from data sets other than price volume? It depends. There are a million ways to define mean reversion in some way or another. Like it's literally just, I have some signal and I expect there to be a reversion to the mean. A lot of traditional ways to do it are using some sort of price reversion or using some sort of returns reversion. If we have a period of particularly high returns, we expect things to go short afterwards. So some of these are going to be better than others. In this particular algorithm that we're using here, that's on the forums, it's a pretty weak form of mean reversion. It's super simple, it's super basic. But you can definitely come up with more interesting ideas, right? Like a pairs trade is using co-integration in order to come up with a measure of mean reversion, where we basically model the spread between a set of assets as a probability distribution and make bets based on this probability distribution. And then you can also fit like an Ornstein-Uhlenbeck model, some sort of stochastic model, in order to further quantify a mean reverting relationship. There are a bunch of ways to do it. I suspect that there are ways to use like fundamental factors or alternative data as a way to express a mean reverting factor, but I haven't really dug into it that much. Most of the traditional ways are using price and volume. So risk factors are functions. To reduce common risk factors, we are looking for our factors to be mathematically orthogonal to the common risk factors. Yeah, ideally you would have a risk factor that is totally independent of the common risk factors. So I've been working on some stuff recently to essentially orthogonalize an alpha vector to a set of common risk factors. So that's definitely something that is worth looking into, right? If you've developed a factor that is totally orthogonal to a set of risk factors, or totally perpendicular, or totally unrelated to them, then it makes it easier for the optimizer if you ultimately do use some risk model exposure constraint, right? Whenever you're dealing with an optimizer, you're trying to get as close as possible to your target, especially if you have a complex set of constraints. So the closer you are, and with low risk exposures and with independent risk exposures, then the easier it's going to make it to actually find appropriate positions. Have you compared this risk model to BARA or other risk models? Yes, we have. Part of the original literature that we were working on incorporated knowledge of BARA, incorporated knowledge of the CAPM, and from a friend. So it's definitely stuff that we looked at in the research process. Can the utility function be included in optimization? Absolutely. However you choose to define that objective, that is how you can define it. Again, if you're using our optimize API, it needs to be a convex objective. Really, whatever you find appropriate for constraints and whatever you find appropriate for objectives, you can pass in. What do I mean by convex optimization for portfolio management? What I mean by convex optimization is that, well, the way in which an optimizer works is we define essentially a space, like this hyperdimensional space. And what we're looking for is either a minimum or a maximum in that space. So what I mean when I say convex is that this space has minimums and maximums, essentially. We have these inflection points in the same way that that you would express the convexity of a smaller two-dimensional curve. You'd look at the second derivative, and you'd kind of go from there. Can we use it in a nested fashion, meaning run the optimizer to allocate the weight of the sectors and subsequently the individual stocks within each sector to adjust the allocation of individual stocks? Yes, you can definitely do that. In order to run several sets of optimization, you would need to write the first set of code yourself in order to come up with the first weights to pass into the optimizer, because currently you can only optimize once, and then that will send out the appropriate orders for your portfolio. But when actually calculating these risk exposures, the way that we do this is by computing individual sector exposures, taking the residual from that, and then calculating the style exposures. So we already kind of do this this nested risk exposure, where we figure out the exposure to an individual sector, then take whatever is left over from that and attribute that to individual styles. So the risk factors already take a little bit of this into account. And if I didn't explain that convex optimization question clearly enough, definitely shoot me an email, and I'd be happy to go into it in a little bit more depth, and we can go from there.
Okay, that looks like all the questions for today. Like I said earlier, this webinar was recorded. You'll be getting a follow-up email with the recording link and also the notebook that Max used. So please look out for that. And I wanted to thank everyone for joining us today, and thank you, Max.
Thank you, everybody.
It's all been building up to this. Free data, free backtesting, free risk model. Use it all to win daily cash prizes in our free contest. Our first submission deadline is February 16th, so don't miss out. Go to quantopian.com/contest for more information about the contest rules, prizes, and to get started on submitting your algorithms.